Have you ever just stared at a price chart and all you can think is, what on earth is going to happen next? Well, you're not alone. That's the one question every single trader asks themselves every single day. Today, we're going to pull back the curtain and see exactly how they try to answer it, breaking it all down layer by layer. And this right here is the fundamental dilemma, isn't it? You see a price moving, it looks strong, but you're hesitating. Is the party just getting started and you need to jump in? Or are you about to be the last person to show up right before it ends? Getting this right? Well, that's the whole game. You know, it's not just a fun little puzzle. This is the core challenge. The skill to look at a chart and tell the difference between a little dip, a pullback, and a full-blown reversal of the entire trend, that's what separates the traders who make it from the ones who are, let's be honest, just guessing. So here's how we're going to do it. We're going to look at this in layers. We'll start at the very surface with the visual stuff that everyone sees first. Then we'll dig a little deeper into the market's actual structure. And finally, we're going right into the engine room to see what's actually making the price move. Okay, level 1. This is the first place most traders start, right on the surface of the chart with candlestick patterns. People treat these like a kind of visual language, where certain shapes are supposed to signal very specific things are about to happen. So let's take a classic example, the bullish engulfing pattern. The idea here is pretty simple. The market's been going down, you get a red candle, and then bam, a big green candle completely engulfs the previous one. To a lot of traders, that's a textbook buy signal. It looks like the buyers just wrestled control away from the sellers. But how reliable is it really? Well, when you actually put that theory to the test, the results are kind of shocking. An academic study looked at this pattern over 10 years and found that less than half of the trades, just 44.1%, were profitable. And get this, the strategy did worse than just buying and holding the stock in 18 out of the 20 companies they tested. Ouch. And it really all boils down to this number right here, 0.89. That's the profit factor. Now, anything below 1.0 means the strategy lost money over time. To put it another way, for every dollar it lost, it only made back 89 cents. So relying on this one popular pattern by itself, it was a losing game. This brings up a really important question. If the market's visual language, these patterns, can straight up lie to us, what's next? How do traders build real confidence? Well, the answer is to look beyond just one or two candles and start analyzing the entire structure of the market. So now we're going a level deeper. Think of it this way. Instead of just looking at individual bricks, we're now looking at the building's entire blueprint. Market structure is all about seeing the big picture, the overall trend, and crucially, figuring out when it might be about to change. And the first big idea here is something called a market structure shift, or MSS. So imagine a nice, clean uptrend, a series of higher highs and higher lows. An MSS happens when the price suddenly breaks below that last higher low. It's like the first crack in the foundation of the trend. It's a warning sign that the bears might be waking up. And on the flip side, you have the break of structure, or BOS. In that same uptrend, a BOS is when the price breaks above the most recent higher high. Now, this isn't a warning. It's a confirmation. It's the market telling you, yep, this trend is still healthy, it's still strong, and we're probably going higher. And this slide just lays out the difference perfectly. A break of structure is like the next chapter in the same story. A market structure shift, that's a huge plot twist. One gives a trader confidence to stay in the trend, while the other is a big red flag saying, hey, pay attention, a reversal might be coming. Okay, so let's say you've got a confirmed trend. You just saw a clear break of structure. The next logical question is, all right, how far is this thing going to go? This is where traders pull out tools that use that market blueprint to project potential price targets. And one of the most popular tools for the job is Fibonacci extensions. Now, you might have heard of Fibonacci retracements, which help you find where a pullback might end. Extensions are different. They're all about looking forward, forecasting where a move might finally run out of steam. It might sound super mathematical and complex, but actually drawing it on a chart is just a simple 3-click process. You click the start of a big move, then the end of that move, and finally you click the bottom of the pullback. And just like that, the software projects these key target levels out into the future. And these are the levels traders are watching. That first one, the 127.2, is often where conservative traders will take some profit off the table. The 161.8, that's the big one, often seen as the primary target for the whole move. And if price just blasts through that and starts heading for 261.8, Whoa, that's a sign of some serious momentum. But it's also a warning that the trend might be getting a little exhausted. Right, so everything we've talked about so far is based on analyzing price that has already happened. It's history. But what if you could see the cause, not just the effect? For that, we have to go to our final and deepest level, into the market's engine room, the order book. I love this quote because it just perfectly captures why traders are so obsessed with this. The idea is that by watching the raw buy and sell orders as they hit the market in real time, you can get a crucial head start, maybe just a few seconds, before the result of those orders even shows up on a normal price chart. See, what makes order flows so different is that it's not about the past. It is about what is happening right now. You're literally watching the real-time battle between buyers and sellers, second by second, to see who's winning and who's losing control at every single price. But, and this is a huge but, especially for Forex traders, there's a catch. Unlike the stock or futures market, which has a centralized exchange, the spot Forex market doesn't. This means the order flow you see from your broker, it's often just a partial, incomplete picture of their own clients. It's not the whole market. That's a really important reason why a lot of pros stick to futures for this kind of deep analysis. So we've gone on quite a journey here. We went from the simple visual language of patterns, down to the market's blueprint with structure, and all the way into the engine room with order flow. So how do the pros actually make sense of all of this? And the key takeaway is this: it is never about finding one perfect tool that works all the time. The real secret is seeking confluence. That's the magic word. It's when different tools, all from different layers of analysis, start telling you the exact same story. So you might see a bullish pattern, which happens right at a key structural support level, and you see big buy orders coming in on the order flow. Now that is a high confidence setup. And that naturally leads us to the big mistakes you want to avoid. First, like we saw with that engulfing pattern, relying on just one tool is a recipe for disaster. You always have to see the broader context. You have to avoid getting faked out by spoof orders, and you have to remember that every single signal needs to be interpreted. It's not about blind faith in one indicator. You know, at the end of the day, the market is telling a very complex story. The patterns are like the words, the market structure is the grammar holding it all together, and the order flow, that's the tone of voice. A great trader just learns to listen to all of it, to truly understand what the market is trying to say.